Whether it's planning for retirement, saving for a college fund, or earning residual income, individuals need an investment strategy that fits their budget and their needs. Comparing an investment in real estate to buying stocks is a good place to start. Hey everyone, welcome back to Crypto Fiend. I'm Lise Garcia, your friend in finance. Today we're diving into a hot debate in the world of investing. Stocks versus real estate. Which one is better for building wealth? In this video, we'll break down the pros and cons of each, compare their potential for returns, and help you decide which might be the best fit for your financial goals. Let's get started. First, let's talk about stocks. Investing in a stock makes you a shareholder in a company. As a shareholder, you can turn a profit by selling shares when the company's stock value rises or holding it while it pays dividends. You can purchase stocks individually through mutual funds or via exchange-traded funds or ETFs. Individual stock investments mean you profit or incur losses based on the performance of the company's stock. On the other hand, mutual funds and ETFs allow you to diversify your portfolio by investing in multiple stocks at once. They often offer the potential for significant returns, but they also come with higher volatility and risk. Historically, the stock market has averaged about 8 to 12% annual return when adjusted for inflation. So what about real estate? When you buy real estate, you acquire physical land or property. Most real estate investors make money by collecting rents, which can provide a steady income stream, and through appreciation as the property's value goes up. Also, since real estate can be leveraged, it's possible to expand your holdings even if you can't afford to pay cash outright. For many prospective investors, real estate is appealing because it's a tangible asset that can be controlled, with the added benefit of diversification. Real estate investors who buy property own something concrete for which they can be accountable. Now let's talk about the most important part, the returns. Historically, stocks have offered better returns than real estate investments. Stocks have returned on average about 8 to 12% per year, while real estate has generated returns of 2 to 4% per year, says Peter Earle. This is an economist at the American Institute for Economic Research. However, other variables like economic conditions and emotional purchasing decisions can result in subpar investments and lower returns. Investing in the stock market makes the most sense when paired with benefits that boost your returns, such as company matching in a 401k. But these perks are not always available, and there's a limit to how much you can benefit from them. Investing in the stock market independently can be unpredictable, and the return on investment is often lower than expected. Comparing the returns of real estate and the stock market is apples to oranges comparison. The factors that affect prices, values, and returns are very distinct. However, we can get a general idea by comparing the total returns of the SPDR S&P 500 ETF, which ticker SPY, and the Vanguard Real Estate ETF Total Return, ticker VNQ, for the last 17 years. As the chart demonstrates, both real estate and stocks can take a big hit during economic recessions. Note the big dips that occurred during the 2008 Great Recession and the 2020 COVID-19 crisis. Now let's discuss the risks involved in each when it comes to real estate and the risks associated with it. The most important risk that people miss is the real estate requires a lot of research. It's not something you can go into casually and expect immediate results and returns. Real estate is not an asset that's easily liquidated, and it can't be cashed in very quickly. This means that you can't cash it in when you're in a bind. The stock market is subject to several different kinds of risks: market, economic, and inflationary risks. First, stock values can be extremely volatile, with their prices subject to fluctuations in the market. Volatility can be caused by geopolitical and company-specific events. Say, for instance, a company has operations in another country. This foreign division is subject to the laws and rules of that nation. But if that country's economy has problems or any political troubles arise, that company's stock may suffer. Stocks are also subject to the economic cycle, as well as monetary policy, regulations, tax revisions, or even changes in the interest rate set by a country's central bank. So in short, stocks have offered higher returns over the long term, but they're also more volatile. Real estate tends to provide more stable, consistent returns through rental income and property appreciation, but it can be affected by market downturns and requires ongoing maintenance. Additionally, real estate investments are less liquid than stocks, meaning it can take longer to sell a property and access your cash. So let's put down the pros and cons of real estate for you guys to get a better understanding. Real estate investors have the ability to gain leverage on their capital and take advantage of substantial tax benefits. Although real estate is not nearly as liquid as the stock market, the long-term cash flow provides passive income and the promise of appreciation. Despite this, it's important to consider the amount of money that goes into real estate investments. You need to have the ability to secure a down payment and financing if you aren't making all cash deals. Since real estate isn't as liquid, you can't rely on selling your properties immediately when you may be in need. Other disadvantages include the costs associated with property management and the investment of time that goes into your repairs and your maintenance. So the pros: passive income, tax advantages, hedge against inflation, and the ability to leverage. And the cons: more work than buying stocks, expensive and illiquid, high transaction costs, and appreciation isn't guaranteed. Now for the pros and cons of stocks for most investors. It doesn't take a huge cash infusion to get started in the stock market, which makes it really appealing. And unlike real estate, stocks are liquid and are generally easily bought and sold, so you can rely on them in case of emergencies. With so many stocks and ETFs to choose from, it can be easy to build a well-diversified portfolio. Stocks tend to be more volatile, leading to a more risky investment, especially if you panic sell. Selling your stocks may result in capital gains tax, making your tax burden much heavier, and unless you have a lot of money in the market, your holdings may not be able to grow much. So let's go over the pros. They're highly liquid, easy to diversify, low transaction fees, and easy to add to tax advantage retirement accounts. And the cons: more volatile than real estate, selling stocks can trigger big taxes, some stocks move sideways for years, and potential for emotion-driven investing. An important aspect to consider is diversification. A well-diversified portfolio includes a mix of asset classes to balance your risk and your reward. Combining stocks and real estate can offer a more balanced approach to wealth building. Stocks can provide growth and liquidity, while real estate can offer stability and income. By diversifying, you can mitigate the risks associated with each type of investment. So the bottom line? Well, you need to think about your personal goals and preferences. If you prefer a hands-on approach and like the idea of owning physical assets, real estate might be for you. If you prefer a more passive investment and the ability to quickly buy and sell, stocks could be a better fit. Consider your risk tolerance, time horizon, and financial objectives when deciding between stocks and real estate. Both stocks and real estate have their unique advantages and can play a crucial role in building your wealth. The key to understand the risks and benefit of each, diversify your investments, and align your strategy with your personal financial goals. Thanks for watching, and remember, successful investing is about making informed decisions and staying patient. Don't forget to like, subscribe, and join our Telegram group for more exclusive finance tips. See you next time.